This is Tradewell's scatter plot tool. It's the first screen you'll see when you complete a backtest in Tradewell. The scatter plot tool can help you move away from trading on news or hunches and become a trader who's more data-driven in your approach. And this is because the scatter plot helps you understand the relationship between an input metric and the future price of the asset you're trading. The scatter plot also takes things one step further by helping you compare the results of your strategy to random results. So you can instantly learn if your trading idea has a better track record than, say, picking random trading days out of a hat. As traders, one of the last things we want to do is make a decision without data. And the scatter plot helps us avoid this outcome because it tells us whether or not a trading setup offers some sort of historical edge. So let's walk through the scatter plot. Earlier we backtested a strategy of buying Apple when the momentum indicator RSI fell between 16 and 30. This was a dip buying strategy that a mean reversion trader might employ. In this example, we're going to be looking at the S&P 500 ETF SPY with the same RSI range between 16 and 30. So let's say one day the RSI falls within our range, triggering a buy signal. Before we take a position in SPY, we want to know, have similar setups been profitable? Have they performed better than buying SPY at any random time? And can we look at points on the scatter plot and see a pattern that tells us something about how the metric and future price interact? The scatter plot tool helps us answer these questions. Let's take a look how. If we're considering buying SPY based on RSI signals, we first want to check that going long these signals offers a positive return in whatever time frame we're trading. If we look at the scatter plot, we see our signals represented by the black dots, and the average 20-day return of our signals represented by the black horizontal line. The line is sitting above 0, which tells us that the strategy is a profitable one 20 days out. Now we want to know if the strategy performs better than random. The green dots represent all of the trading data, and the green horizontal line represents the average 20-day return of these data points. We can see that the return of our strategy exceeds the random return because the black line sits above the green line. Now we also want to know whether the metric and the future price of SPY relate to each other. And looking at the data points, we notice that most of the black dots fall above the 0 line, with a few slightly below, as well as a couple large outliers. Based on this, we can conclude that buying the dip on SPY with a 20-day holding period is probably a pretty good bet.